Tesla, TSLA, has been struggling lately and is down 18.87% in the last 3 months. The following option plays give different ways to play the stock depending on an investor's risk/reward preferences and directional outlook. The technical opinion rating is a 8% sell with the weakest short-term outlook on maintaining the current direction. Rather than just buying the stock, investors can use the options market to find smart ways to trade Tesla stock with an attractive risk-to-reward ratio. Implied volatility is high at around 61%. The 12-month low for implied volatility is 36% and the 12-month high is 87%. The 4 percentile is 59%. That means it could be a great time to be a seller of options on TSLA. Option trade idea 1, bull put spread. A bull put spread is a defined risk option strategy that profits if the stock closes above the short strike at expiry. To execute a bull put spread, an investor would sell an out-of-the-money put and then but a further out-of-the-money put. This bull put spread trade involves selling the March expiry 900 strike put and buying the 880 strike put. Selling this spread results in a credit of around $9.40 or $940 per contract. That is also the maximum possible gain on the trade. The maximum potential loss can be calculated by taking the spread width, less the premium received and multiplying by 100. That give us 20 to 9.40 x 100 equals $1,060. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 88.68%. The probability of the trade being successful is 46.2%, although this is just an estimate. The spread will achieve the maximum profit if TSLA closes above 900 on March 18, in which case the entire spread would expire worthless, allowing the premium seller to keep the $940 option premium. The maximum loss will occur if TSLA closes below 900 on March 18, which would see the premium seller lose $1,060 on the trade. The break-even point for the bull put spread is 890.60, which is calculated as 900 less the $9.40 option premium per contract. Option trade idea 2, short iron condor. The next strategy we will look at is a short iron condor. An iron condor aims to profit from a drop in implied volatility, with the stock staying within an expected range. When implied volatility is high, the wider the expected range becomes. The maximum profit for an iron condor is limited to the premium received, while the maximum potential loss is also capped. To calculate the maximum loss, take the difference in the strike prices of the long and short options, and subtract the premium received. Traders could sell the 840 strike put and buy the 770 strike put. Then on the calls, sell the 910 call and buy the 980 call. Earlier today, that condor was trading around $34.45, which means the trader would receive $3,445 into their account. The maximum risk is $3,555 for a total profit potential of 96.91%. The profit zone ranges between 805.55 and 944.45. This can be calculated by taking the short strikes and adding or subtracting the premium received. Let's take a look at another potential option strategy. Option trade idea 3, bear call spread. If a trading thinks that TSLA stock will decline, or at least not rally by much, they could look at a bear call spread. The trade would involve selling the 925 call and buying the 950 call. That spread could be sold for around $8.30, which means the trader would receive $830 into their account. The maximum risk is $1,670 for a total profit potential of 49.7% with a probability of 61.2%. The break-even price is 933.30. This can be calculated by taking the short call strike and adding the premium received. As the spread is $25 wide, the maximum risk in the trade is 25 to 8.30 x 100 equals $1,670. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. For a bull put spread, setting a stop loss of 25% of maximum risk is a good idea. In the case of the TSLA example above, that would be a loss of around $265. For the iron condor, a stop loss of 20% or around $710 would be a good idea, and for the bear call spread, a stop loss around $420 makes sense.